Hey, in last week's video, we talked about a case study where the RMD tax bomb caused a retiree to pay 30% in taxes due to their RMD. This week, we're going to talk about 7 strategies you can use to lower your RMDs. Now, it's important to understand before we get started that most of you are going to be required to take RMDs at 72. Now, the time to deal with RMDs is not at age 71 or 72. Okay, the time to deal with RMDs is now. Okay, build a forward-looking tax plan to minimize RMDs into the future. We're going to talk about why that's so important as we go through these 7 strategies. But the first strategy is to delay Social Security. If you're retired and delaying Social Security, you're in what we call an income gap. Okay, before Social Security starts, your income needs to come from somewhere. Okay, a great strategy for many retirees is to delay Social Security into the future, and in the meantime, use tax-deferred assets for your income today. Okay, basically what that's going to do is by taking large withdrawals from your tax-deferred accounts, you're going to lower that RMD into the future. But you also get a double benefit because while you're delaying Social Security past full retirement age, you get an 8% step up in benefits. Okay, in this low yield environment where we're seeing interest rates below 1%, an 8% benefit is fantastic. Okay, and so delaying Social Security into the future, using tax-deferred assets right now can be a great strategy that many people on this call can use. Number 2 would be Roth conversions. Okay, now the IRS gives you a loophole, a backdoor loophole, where you can take IRA tax-deferred assets, pay taxes on them today, and convert them to Roth IRAs. And they'll be tax-free for the rest of your life. Now, I actually looked today, out of all the plans, retirement plans that I've built, less than 5% of them do not have a Roth conversion strategy involved in them. And so this is going to apply to many retirees. Right now, we've said is the once in a lifetime opportunity for Roth conversions. The reason being is because of the Tax Cuts and Jobs Act. What it's basically done is lower all tax brackets at about 3%. And so that's set to expire in 2026, and all brackets are set to go back up to those higher levels. And so right now, we know that taxes are set to go higher in the future. We're going to be hosting a webinar in August. We'll let you know when that is in next week's email, but stay tuned for that. We'll be talking a lot about Roth conversions and why they make so much sense. Number 3 is asset location. Okay, so when you think about all of your retirement accounts, you have tax-deferred accounts, taxable accounts, tax-free accounts, okay, and you're investing in a lot of different assets like stocks, bonds, CDs potentially, okay? Take your lower yielding assets and put them in your tax-deferred accounts. Okay, take your higher yielding assets and put them in your Roth accounts. Why? Because you already paid taxes on that Roth money, and so you want that pool getting as big as possible. So putting your stocks in your Roth assets, putting your lower yielding assets like CDs and bonds in your tax deferred assets will just innately keep those tax deferred assets growing at a lower rate, keeping those RMDs smaller. This is something that everybody on this call should be doing. View your situation as a whole. Don't view each account separately, okay? Number 4 is to use a qualified charitable distribution, a QCD, and give that RMD to charity. Okay, so in last week's example, we talked about how this retiree was charged 30% in additional taxes because of that RMD. Okay, well, at that point, if they keep the RMD, they don't need it. They don't need it for income. If they keep it, they're only getting 70 cents on the dollar for that RMD. What they can do is if they have a cause that they care about, a nonprofit, they can basically assign that RMD to that nonprofit and completely remove that RMD from their taxable income. Okay, basically what that's going to do is rather than them getting only 70 cents on the dollar, they can give 100% of that money to a charity, to a cause they care about, keeping it out of the IRS's hands. Okay, number 5 would be take out more than your RMD requires. And so again, looking to last week's example, they were charged 30% in extra taxes because of their RMD. Well, let's imagine that at that point they were at full Social Security taxability. and their normal federal income bracket is 22%. Okay, so if they take out more than their RMD, they're going to be charged 22%. Now we know in the following years, because it's going to move more of their Social Security into being taxed, they're going to be charged at 30% basically each year, especially as that RMD grows. Well, what they can do this year is take out more than they're supposed to, pay that 22% tax, but avoid that 30% tax into the future. So sometimes taking out more than your RMD requires can help minimize RMDs into the future. Number 6 would be if you have a spouse that's considerably younger and potentially still working, it might make sense to take your RMD and contribute to your spouse's IRA. So let's give an example. Let's say you're 72. Your RMD for this year is $15,000. Okay, let's say your spouse is still working and they're 64. Okay, what you can do is you can take your $15,000 RMD, have your spouse contribute $15,000 to their 401k or other IRA assets. And basically what that'll do is you're supposed to pay taxes on that RMD, but because you're contributing it to a tax deferred account, you get a tax deduction. And so basically it wipes out that $15,000 RMD and allows you to basically kick the can down the road, if you will, and give you more time to deal with that RMD situation, because that money is going to be on your spouse's RMD schedule and not on your RMD schedule. So if there is a large gap in your ages, that can be a great strategy to use. Number 7 is keep working. Now, I know most of you don't like hearing that as a strategy, but in some cases it can make a lot of sense, especially for business owners. Okay, so let's imagine that you're working late into your 60s. Maybe you love the job. Maybe it's easy enough that why not keep working? Well, what can make sense is rather than retiring and being forced to pay your RMDs while you're working, there's an IRS loophole that allows you to basically forego your RMDs if you're working at the employer that carries that 401k. And so what can make sense is to step into a consulting role, stay on the payroll in some sort and fashion so you're continuing to work, and that'll help you avoid RMDs. Okay, so for a business owner that can stay on their payroll rather than retiring completely, that can make a lot of sense and allow you to avoid RMDs basically indefinitely. And so hopefully these 7 strategies made a lot of sense. Hopefully they showed you how you don't have to simply take your RMDs and pay the taxes that tax bomb requires you to. You have 7 different strategies that you can use to lower your RMDs. Okay, again, we're going to be hosting a Roth conversion webinar sometime in August. We'll let you know next week, but hopefully this was valuable. Hopefully this taught you how you can avoid paying taxes and minimize your RMDs in the future. Always remember, you don't need more money. You need a better plan. Thanks for watching. Have a great weekend.